Now, this is probably one of the chapters that a lot of you have been waiting for. We're going to talk about how you can make money trading Forex. The first thing we want to talk about is how position sizes are measured, because you don't just come into the market and hit buy. You have to determine how much of your overall account are you willing to risk on said trade. And like we talked about before, leverage can make it easy to risk your entire account on one trade. And a lot of people have come into this business and done that, and it gives them a sour taste naturally in their mouth because this is how I want to explain it. They place a trade, so they think they're trading, but their position sizing is way off, so they're way more like gamblers than traders. So before we even have you get to that point, let's break it down and give you an understanding of how to size your positions correctly. So first, understand that we measure it in units. You can think of units as shares. You'll hear the word lot size. That is a different characterization of the units. So for example, a standard lot, you can write that as 1.0. That's 100,000 units of currency. A mini lot is 0.1 lots. That's 10,000 units. And then a micro lot is 0.01 lots, and that's 1,000 units. Do you remember back at the beginning, I said before 1980, 1990, currency trading was done in the millions of lots. Millions of lots. So we're talking tens of millions, if not billions of units of currency. Now, because of competition, because of the internet, because of all the things we've talked about already, now you can trade as small as 1,000 units of currency. So you can see, just for comparison, the reason I tell you that is that's how much competition has shrunk the gap between the institutional traders and us as retail traders, the banks and us. So then we want to know, okay, Austin, I can read the units. I understand 100,000 units is a standard. Make sure you guys take a picture of this. Save this if you're brand new, print that out. So then you want to know, well, how many units should we trade? Well, position size is based off of two things. Number one, is it a high probability setup or a low probability setup? Now, this is the part of where I teach that you will not hear any other Forex traders, many other coaches in trading talk about. A lot of people think every trade gets the same amount of risk, and that doesn't work for me. It didn't work for me for a year and a half when I first started trading. That was what I was doing until I learned by reading from other traders that that wasn't the only option. I actually could say, hey, is this a better trade than this? Okay, if this is better, shouldn't this get more size than this? Just logic. So number one, you want to base the size on the quality of the setup. And again, not all trades are the same. And number two, you want to base the size of that trade, how many units you put into that trade, based on a percentage of your overall account. So this is a beautiful example that I like to use. We've got Bob and we've got Joe. Two different account sizes. Let's say they're going to take the same exact trade for this example. Let's say they want to risk 2% for easy numbers, and their stop loss is going to be 10 pips away. If you don't know what a stop loss is, we'll talk about that a little later too, as we get into the toolkit and we get into the charts. But the stop loss basically is placed either below or above, depending on if you're buying or selling, your entry price to stop the losses. If you're buying it, if you place a buy order and it comes down, you want a stop loss in to stop the bleeding and get you out of the trade, because it could keep coming, and actually potentially blow your entire account. Or you at least get margin called. And then if you were selling it, your stop loss would be above, because if you're selling it, you want price to go down. If price starts to come up, you want to get taken out of the trade. That's basically what a stop loss is. So these guys have a 10 pip stop loss in. 10 pip stop loss at 2% risk of Bob's account is only 20 bucks. That same 10 pips of movement with the stop loss there is going to be worth $200 because Joe has more money in his account. So he's going to trade 2 standard lots versus Bob is only going to trade 0.2 lots. Same trade, they're doing the same analysis, they see the same thing, but because Joe has more money, he's going to have a bigger position, the 2 lots versus the 0.2 lots. Now in units, that's 200,000 units versus 20,000 units. The potential profit on this trade, because they're looking at the same trade, it's the same, 40 pips. So if they're risking 10 to make 40, Joe is risking 200 to make 800, Bob is risking 20 to make 80. The problem that people run into is Bob will over leverage his account. He will trade the same position size as Joe. He will then lose $200 of his $1,000 account, and that's way more than 2%, right? He loses 5 of those trades, he's gone. You follow me? So your position size is based on a percentage of your overall account. Now, we're going to get into the differences in which setup should get 2% versus which setup should get 1%. We're gonna get into that later. That's a little bit too technical for right now, but just understand, if you have a different account size than someone, they could be making thousands of dollars per pip while you're only making a few dollars per pip. It's always based on your overall account, which is, if you look at my content, I never post how much money I'm making because the amount of money I'm trading is different from the amount of money you're trading. I've always shown my profits in percentages and in pips. Percentages is the best thing because then you can see how consistent the gains are. Some I make 0.6%, some I make 2%, some I lose 0.2%. You can see that gain and loss and that consistency regardless of how much money I'm trading, because that doesn't matter. I don't want to distract people with that, if you were wondering. Now, we've spoken about brokers before. Brokers are basically like your trading bank account. This is the person who's holding your money. This is the person who's going to quote your price. They're plugged into the ECN. They're using the ECN that we talked about earlier to get the data from the big banks above them in that hierarchy, and they're going to feed that price to you. And they want to get you a good price because if you trade with them, they're going to make small amounts of profit on each trade that you place. And that's how brokers make money. So I got an example for you here. This is Euro USD. We're going to take a short, or excuse me, it's Euro AUD right here at the top. We're going to take a short position at 1.5911. Now, that price right here, that price right there, I did not put the pipette on it because I don't really care about the pipette. It doesn't make that much of a difference. So I'm looking at this last digit here as my pip. Now, we're risking with this setup, with our stop loss up here, we're risking 28.6 pips. The potential reward with this setup is 65 pips. So in this situation, if we were trading 100,000 units, that's roughly $280 worth of risk for a reward of $650. So if I can teach you how to identify 2-to-1 risk opportunities like this that present at a win rate of maybe 7 to 8 or 9 out of 10 times, wouldn't that be a system that you would want to trade? Just math. If it's winning at 2-to-1 and it's winning 7 or 8 out of 10 trades, no matter what, even if you take a short-term loss, that system will be profitable for you long-term, and that's where we want to push you. Now, all this foundational knowledge is great, but this isn't enough to get you trading, right? We need to then implement a winning system, but we need to cover this foundational stuff first. So you can see there's our price, 1.5910. You can see the stop loss right there at 28.6 pips. Then you can even see the take profit listed at the bottom. So with TradingView, this is where you're seeing me do all my charting. They will quote that price, as you can see, at 0.00658. Just don't forget to move your decimal. That's just 65.8 pips. That's all. Don't get even distracted. Here it's 28.6 pips, even though TradingView paints it at 0.00286. So just move your decimal and you'll be good to go. And like I said, just to kind of circle back here, if you had a $10,000 account, 2% risk is $200. So in a situation where 1R is your risk, we're looking for that 2R at least. So if I'm risking 200, I want to make 400. If I'm risking 2,000, I got to make 4,000. I can't go risk $2,000 and only make 1,500. That's not going to cut it when it comes to a winning trading system. So if I'll ask you again, if I could show you how to win 7 out of 10, if not more than that, of your trades at 2-to-1, wouldn't that be a system that you would feel confident to put your money in? That's what we're going to get to. So now in the next chapter, we're going to talk about the winning trader mindset, because as much as all this technical stuff and this foundational knowledge is really important, if your mindset is wrong, you're not going to make it in this business. Listen, there are more people that fail in trading than there are who succeed. So without a proper mindset, none of this is worth anything. So let's move into the next chapter.